Hello everybody. So this video is the evolution of my most undervalued spreadsheet videos that I've been doing for more than 2 years now. It's the video where I go over my spreadsheet that I share on Patreon and I discuss the stocks that I find to be the top. And I have more than 200 stocks that I analyze and that I screen, and I always seek the top stock out there. Now, before I go through a spreadsheet and tell you about these stocks, by the way, that I have named super gems, I need to remind you of my investing style. How do I generate alpha? Well, I have 3 main ways to do it. I have 3 main investing buckets. These investing buckets are bucket number 1, the debasement plays, and of course the lion's share, not the lion's share, but maybe 1 video out of 3 lately has been about MicroStrategy, because that's the debasement play, i.e. beating the debasement, beating the denominator. That's why I named this channel Beat the Denominator back in the day, because initially I wanted this channel to be all about just beating the money stock growing, beating the growth in the money stock, beating the fact that there's ever more US dollars that are getting printed, and so the value of our assets is being just debased, and the value of our stocks is being debased. The value of everything we value, our time, our labor, is getting debased by the fact that the money supply just always grows. And initially, in my bucket number 1, I actually had real estate plays, real estate stocks in there. You may remember there was a stock I had covered about the Empire State Realty Company owning the Empire State Building. And I've shifted entirely out of real estate, and real estate in the real world too. I used to have rental properties that I sold. I just have one last house, which was my house that I'm trying to sell right now, and it's a big house, so it's tough to sell in this market. A big house in Texas, tough to sell. So it's still listed. I'll see when I sell it, but I'm fully exiting real estate and I'm renting. I'm fully exiting real estate, and my debasement play is not real estate anymore. It is Bitcoin, and so I've been in Bitcoin for a long time and understand close to 10 years. But more recently, I've been into MicroStrategy. MicroStrategy has been a life-changing investment for me. It's been a life-changing investment for a lot of people out there, not just me. And that's why I cover it many times on this channel. Even almost 2 years ago, I was covering it. And the Bitcoin miners have not run yet, but in my view, they will. Bitcoin, MicroStrategy, and Bitcoin miners, they are a good replacement for real estate in my view. And ideally, and of course you can't really do that for pure form Bitcoin right now, but ideally I like to find an asset that mixes debt within a hard asset, which is the same thing that people do with real estate, right? Real estate, you borrow a little bit and then you buy real estate. That used to be the playbook. I think the new playbook is stocks that borrow a little bit, and we know that MicroStrategy in the debt structure, well, it's less than 20% debt in their debt structure over there at MicroStrategy. I think it's a safe way to have a little leverage. So you sprinkle a little leverage, you sprinkle a little debt in a company that mostly holds Bitcoin. Just like you sprinkle a little leverage, a little debt on, say, some real estate from when real estate was still a good investment. In my view, I don't view real estate as a good investment anymore, and it's because of taxes just going through the roof, insurance, the cost of repairs. I mean, just look at like the average cost of, say, replacing a roof. The cost of replacing a roof has like tripled in the past 5 years, maybe, something like that. And so real estate just makes absolutely no sense anymore, in my view. It's just people haven't gotten on the memo. They haven't caught the memo, and so that's why I'm when you go on YouTube, there's so many real estate channels. Anyways, my view is Bitcoin, not bonds. This is because I don't own bonds, but also Bitcoin, not real estate. And this play is purely a debasement play. And so it does not fit well at all into the idea of innovation, the idea of revenue growth, the idea of selling a product, making a profit. It's an entirely new way of thinking about an asset. That's my bucket number 1. Bucket number 2 is quality stocks regardless of valuation. quality stocks, regardless of valuation, but stocks that I select because I believe they are likely to beat the growth in the money stock, to beat the growth in the money supply across the next 10 years. That's these stocks. And so these stocks are selected purely based on my own qualitative assessment of these companies on my part. It's a pure qualitative analysis. This is not quantitative. I ignore valuation in these picks. I ignore valuation. I just look at, are you the best stock? And are you likely to dominate your industry, right? So Tesla, one of the easy ways I would describe my Tesla thesis is there's 1.8 billion cars that are gas cars that are likely going to go the way of electric. Why are they going to go electric? Because a tank of electricity, quote unquote, for almost 400 miles is $7. A tank of gas for almost 400 miles is $70. So it's 10 times cheaper to fuel. And so I think for that reason, I think most of the world is going to shift towards electric. And it doesn't matter if you think Tesla is going to have 10% market share and is going to be responsible for 10% of the 1.8 billion cars that have to be replaced, or if it's going to be responsible for, say, 25% of the 1.8 billion cars that are going to be replaced. No matter what number I put on there, I come up with a number that tells me that Tesla is way too undervalued. What if Teslas are like iPhones? What if Tesla is 25% market share across the long run, knowing that right now in the United States, Tesla is just above 60% market share? I've been hearing for 3 years that the market share was supposed to drop. It hasn't dropped. It's still in the 60s. So anyways, and I could make you the same analysis, for Amazon. Amazon obviously is the leader in the US of e-commerce. Palantir, I'm playing with banks' money. I sold my initial investment. I sold it in the form of a little gain, and I paid off initial investment, and it's the house money. So I'm not touching Palantir anymore. I know a lot of people say Palantir is nosebleed valuation. Nvidia, I would have done the same way. Unfortunately, I sold my entire Nvidia position, but I made a mistake, right? Nvidia, I should have just sold whatever I had put into Nvidia, and then just kept the rest, right? That's what I'm doing with Palantir. Trust me, I made that mistake with Nvidia. I'm not making that mistake with other stocks of Palantir. CrowdStrike is, if you look at the resiliency, they had this major outage right in July. Stock dropped so hard, and it's almost back to the level where it was before July because they are qualitatively the best cybersecurity play. And then I have Google. You may know that I'm big on Google. I don't cover it a lot on my channel. There's many reasons why I'm big at Google. Of course, Google is the leader in AI. Remember that these GPTs that we talk about, this AI revolution, these GPTs, who created the GPTs? Oh, wait, it's Google, right? So unbeatable in AI, in my view. Perhaps, I would put them, as far as AI goes, just as good as a Palantir, and obviously, in my view, just as good as an OpenAI. But the reason why I love Google so much is their SpaceX exposure, nearly 8% ownership in SpaceX, and we saw SpaceX was now valued at a $350 billion valuation. What is SpaceX? Is a multi-trillion-dollar company in the future. I don't think it is that far-fetched when you're a long-term thinker. When you think about things 10 years out, it is not that far-fetched to imagine that SpaceX could be a $2 trillion or $3 trillion company, and then Google, imagine that gain just on Google, just on that 8% ownership. So that's why I own Google. That's my bucket number 2. Quality only, and I select bucket number 2 only based on quality. Bucket number 3 is my quality and objectively accessible stocks. It's both a mix of quality, and I need to objectively be able to assess them. And so when I have a mix of both quality and objective growth, and of course I select them, and I want them to be at a low price or a relatively low price. That's why I call this my most undervalued spreadsheet stocks, and so they are quality stocks, and for me to include these stocks in the spreadsheet, I have to like what the business does in the first place. So no dying industry, innovation. It has to be innovation based. But then it's backed by the numbers, and the numbers include next 12-month growth, profitability, rule of 40. These are all the numbers that I look at, and there needs to be a mix of both quality and cheapness and profitability. And that's my bucket number 3. And today's video is about this bucket number 3. So let me get started and let's talk about these quote-unquote super gem, which I assess them based on objective factors in addition to qualitative factors. So I find them to be good companies, but they're also objectively cheap right now. The first company in there is LifeMD. LifeMD is a digital doctor. They focus a lot on primary care. They focus on doctor visits. They provide them online, and they mostly operate outside of the insurance industry. When I look at the valuation of a LifeMD on an enterprise value over gross profit, over revenue growth, I get a 0.05. So it is dirt cheap. It is cheaper than HIMSS. It is the cheapest of the gems. Out of all of the stocks that I have that I achieve a rule of 40, LifeMD is the cheapest of all of them. And they're predicted to grow revenue at 29%. Their gross margin is 89%. EBITDA margin is 12%. That is growing fast now. And so they're past that J-curve. They're past the losing money. And I believe they have the potential to be, let's call it half of HIMSS. Half of HIMSS. And the reason why I say that is because they still mostly don't fulfill their drugs. They still mostly don't fulfill their pharmacy. But LifeMD recently opened up their first pharmacy. And so eventually, if LifeMD's prescriptions from all of their doctors on their platform, if these prescriptions are fulfilled by their own mail pharmacy, they could be, closer to a HIMSS down in the future. And do I believe there will be competitor to HIMSS? It's likely there will be competitors to HIMSS. It's a stock that I own. I've been adding to it recently. The numbers just look too good, and they also have the GLP-1 opportunity in the background, just like him. So I like this stock, LifeMD. I like it very much, and I'm happy that I'm adding to it. Moving on to GigaCloud. So GigaCloud can be described the best as a drop shipper. So a drop shipper is simply that someone that ships the product from a manufacturer to the end customer, but the end customer doesn't know it because the end customer maybe bought the piece of furniture or the toy. They sell bigger items like a playhouse, for example. That's something GigaCloud will sell, or a couch. Maybe the customer bought that couch on TikTok Shop. Or maybe they bought it on some social media, and you are the one who sold that couch, but in the background, it's a drop shipper. It's GigaCloud who ships it on your behalf in the background. So that is the business. The business is a network. It's a two-sided network with sellers and buyers, and they specialize in bulky items. And, some people have come after GigaCloud for saying, oh, it's a Chinese company in disguise. They've done the same thing with SMCI, come out at SMCI and say, oh, it's a Chinese company in disguise. To me, it's not. To me, these companies are not Chinese companies in disguise. They are American companies, perhaps led by Chinese immigrants. But let's face it. If you're a Chinese immigrant in the United States, your loyalty, in my view, is in the U.S. As an immigrant myself, I can tell you my loyalty is with the U.S. So I see no reason why the leaders of these companies don't see themselves as American. And so GigaCloud, yes, it's listed in the U.S. The leadership may be Chinese, but it's no case to say that they are a Chinese company. Anyways, the point on this one is the enterprise value over gross profit or revenue growth is 0.1. So that's quite cheap, not quite single digit, although we're running out of single digit EV over GP over RG stocks with the market being the way they are right now, but it still achieves a rule of 40. The EBITDA margin is 14%. Gross margin is not that great, but then it's a platform, so it's pretty standard for platform. But the revenue growth is great at 39%, and so in my view, the stock looks good. I don't own it. I haven't pulled the trigger. There's too many good deals out there, so I don't know it. A stock which is, as far as stock proper goes, HIMSS is my third largest position, right? It's MicroStrategy, followed by Tesla, followed by HIMSS at this point. So HIMSS is a stock I was buying in the 6. My average on this one is in the 6. what's funny about HIMSS is that it's consistently, I guess it's only recently that it was a 0.12 throughout. So I've owned this stock for about 2 years. Throughout, say, the last 2 years, 18 months, HIMSS was trading under 0.1, and it just recently got to a 0.12. But keep in mind, anything under 0.25 I consider dirt cheap. So if this stock doubles again, it will still be on this spreadsheet, and I will still call it cheap, and it will be right next to a ELF or right next to a Celsius Holdings. It's to say how cheap this company is. This company is predicted to grow at 53% next 12 months. Gross margin is 79%. They are now firmly into profitability territory, and I use EBITDA margin as a proxy for free cash flow because it's less subject to one-time items. Also, the reason why I use EBITDA margin is that all companies report EBITDA margin. It makes comparison much easier when you use EBITDA margin, because you know they all present EBITDA margin in a favorable light. The advantage of that being that they all compute it the same way. Earnings may not be the case. If you use earnings, you'll have CEO. Sometimes they don't want to pay too many taxes, so they'll be like, oh yeah, we didn't make any money. They'll play with the discretionary accruals in the accounting, and there's an entire area in the field of accounting which is decide depreciation and amortization. What kind of schedule should you use, whether you want to have a tax today or a tax tomorrow. So anyways, EBITDA margin removes the depreciation and amortization. It makes it much clearer to assess the economic profitability of a firm, which is why I like it very much. And when I look at EBITDA margin, all of these companies are good. Some of them are excellent, like TideWater is excellent. Oddity is excellent. Celsius and ELF is excellent. We'll get to those in a second. Don't forget, because these companies grow so fast, in my view, their EBITDA margin should grow even faster at this point because they are so early on in their journey. HIMSS still achieves a rule of 40 of 66. So that's pretty high. That's well over 50% higher than the minimum in the spreadsheet, which is over 40. So HIMSS, still love HIMSS very much. I cover HIMSS a lot on this channel. I think they are just getting started on their journey of becoming an e-doctor and an e-pharmacy without insurance, and there I had in the future perhaps a manufacturer of these generics, because HIMSS is working on manufacturing right now generic liraglutide, right? They have a former CEO of Teva Pharmaceuticals on the board, and they bought this company in Los Angeles, and they may start making their own GLP in the form of once daily liraglutide. And so I think that would be interesting to have a fully vertically integrated healthcare play. I like HIMSS very much. I consider HIMSS to be a special company. Now let's talk about TransMedics. TransMedics has come under pressure lately, right? The CFO is leaving, getting replaced by a new CFO. It's never a good sign when that happens. Why are they under pressure? Well, even though they've kept their market share constant, they have operated and they have had less transplants in the last quarter, and we will see if that continues in the next quarter. It seems like a lot of the hospitals are engaging in normothermic. I can't. It's this very long word, but it's essentially a lot of hospitals are engaging in this practice where they keep a patient alive at the level where the organ is. And so there's a lot of ethical concerns with this practice, because a patient may be quote unquote brain dead, but they have blood still flowing to save a heart, because they gotta wait for the transplant. And so a lot of U.S. agencies have been reviewing this practice. This practice of normothermic transplant is heavily criticized. It's heavily criticized, and of course, TransMedics doesn't believe it's the best in industry. At a fundamental level, I mean, you're putting blood back into someone's body to get access to their organ. At a fundamental level, I think it's easy to understand why the nervous system might feel something, right? And it's about making sure that the veins are being cut off from the brain, and that's not connected to the brain. But I don't understand it at all. But I can see why this could be a major ethical concern. But they do that just to save money, which makes it even more of an ethical concern. It seems like this tactic has picked up at hospitals, and so TransMedics is having a hard time selling its multi-hundreds of thousands of dollars per transplant service. That's why the growth is still predicted to be very high, but that right now this stock has a question mark attached next to it. Now, I still own it, and actually trading at 71 right now. I'm right at my cost basis. So all of my gains that I used to have on this one, all of my gains have been erased, but I am not in lost territory. I've added to this stock recently when it dropped a few weeks back. We'll have to see, if it drops into the 60s. I might not have a problem taking a risk if it drops into the 60s. I think it's all about that procedure and thinking about that procedure. There's a lot of other advantages. Turns out, they bought an airline to move the organs. And a lot of people are concerned that running an airline is not their core competency, and maybe they shouldn't have done that anyways. We'll see how this goes. Let me move on to. So I own TransMedics. I've added recently to it, but it's not my most high conviction play. To be honest, I have a much higher conviction in a LifeMD or in a HIMSS or in a Celsius, for example, or in an Oddity. So I'll get to the rest of the companies now. Let's talk about TideWater. So TideWater. So if TideWater on the number looks great. So what does TideWater do? TideWater is a vessel, an oil servicing vessel company specialized in offshore drilling. So they don't do the drilling, but they do the servicing. They bring on the pipes and the equipment and whatever the people on the oil rig need. TideWater is in charge of this vessel transportation related to the servicing of the offshore oil facilities, oil rigs. And the numbers look really good, and the revenue growth there can be explained by the fact that there's been an underbuilding in those ships. There's a shortage of vessels to service those oil rigs, and because of this underbuilding, the company is able to pick up market share and to pick up growth. Now, the stock has been down over the past few weeks for a reason that I frankly really understand, which is this whole idea of the drill baby drill environment. I kind of like saying that. I don't know, drill baby drill. So I don't know. It's funny, right? But it's true that we know that the new administration in the U.S. is all about drill baby drill. So what's going to happen to the cost of oil, right? We know that the new administration is likely going to encourage more drilling, more oil, and so if the cost of oil goes down, that means that these companies in the oil business, they make less money, and if they make less money, maybe they buy fewer services from TideWater. Maybe they do one less trip. Maybe they do one less servicing. Maybe they start negotiating a little harder. So I realize that TideWater is not a one-to-one correlation to the price of oil. I fully realize that, but they're still connected to an industry who may be inclined to engage in cost savings because the cost of oil, the commodity of oil, the cost just went down, and so you're going to negotiate a little harder. So oil would have been a better environment under, say, a different administration where we know it was no drilling, and then the cost of oil would have gone up. So So anyways, we'll see. Maybe it's misplaced. Maybe my views on the oil price are misplaced here. Nonetheless, the numbers look great on this company. Moving on to Oddity. So Oddity is a stock I own, is a stock I like. It's a stock that I seem to be the only one to like and cover. I like Oddity more than ELF because Oddity makes its products in Europe. I actually believe they make a lot of it in Italy, I believe. They make the products in Europe, which means that as far as the tariffs go, by the way, Oddity, if you don't know, is the brand Il Maquillage, and Spoiled Child, it's another brand. So it's Il Maquillage, which is their biggest brand, is foundation. So they are an AI foundation. So what that means is an AI foundation. That means they have an entire questionnaire, and they will try to color match the product to the woman buying the product. So it is one-to-one marketing, one product customized to one skin tone. And if you know anything about foundation, a big issue in the foundation business is finding the right color for women that matches their skin tone. Oddity uses AI, data machine learning, in order to do a better color matching. And as a result of that, when someone finds the right color, and if it happens to be Oddity that won the business, they have the best color for that person will keep buying. So it creates a recurring revenue business where that person keeps buying because they finally found the right foundation and they don't want to go try something else. And it's a disruption of the older way to do it. The older way to do it works with shades or with numbers. So that's kind of how it works. It uses AI to match one product to one person. In this case, one cosmetic to one person. HIMSS does the same thing with customized medication. One patient, one customized compounded medication with just the right amounts of whatever the doctor thinks you need. But the main difference, of course, is that Oddity can go full AI, and you can use a full AI recommender system to tell you what foundation to buy. HIMSS, of course, needs to go via doctors because only doctors have the license to heal. So HIMSS has to share some of that profit with the doctors. Odd doesn't do that because it was able to move straight to AI. Of course, the vision of, say, HIMSS is, 10 years down the road. If AI doctors become a thing, I anticipate HIMSS will be the first one to implement AI doctors. Anyways, so Oddity, how does it work? How are they able to grow? They're predicted to grow 33% next 12 months. That's excellent. The gross margin is makeup, right? It's a derivative of oil and gas, if I'm not mistaken. It's a petrochemical industry derivative. Yes, thank goodness we do not use lead anymore in this product. So it's that derivative, and so the margin is excellent at 72%. EBITDA margin is even greater at 23%. How much am I paying for that growth? I'm paying a 0.16. So this stock has been consistently cheap, and it achieves a rule of 40 out of 56. So I like quite a bit about this company. I like the price, I like the sector, I like the recurring revenue, and I like the use of AI and the use of social media to grow. And I like, lastly, the direct-to-consumer. The direct-to-consumer. This is a direct-to-consumer business, just like LifeMD, just like HIMSS, right? Direct-to-consumer business. You're paying to, you're selling to the end consumer, you're selling to the decision maker. Right? In the case of, say, of TransMedics, the consumer is the patient. The patient is not dealing with TransMedics. The patient is dealing with their transplant hospital. That's who the patient is dealing with. And then the transplant hospital is trying to find a way to cut costs, and so they go for normoforming regional perfusion as opposed to going for the TMDX latest gen. So you have key decision makers at each hospital that make the decision. In TideWater, you have key decision makers that make the decision at the oil companies, right? In Oddity, each consumer of the end product is a single decision maker, and so the business, in my view, is more predictable. It's more sticky. That's why I like this direct to consumer businesses quite a bit. Let me move on to SMCI. I covered SMCI this morning. What did I say this morning? Well, for the third time, they tell us no accounting restatement is needed. And for the third time, they tell us no fraud. And this time, it's an independent forensic auditor that says that. And so I already saw in the comment section some people saying when I posted that video in the morning, some people in the comment section were saying, "Oh, well, I still don't believe it. It's still fishy." So I don't know how many times a report has to come to say that there was no accounting shenanigans. I don't know how many times there needs to be an independent agency, company, council that comes out and say there's no accounting restatement. It's 3 times now. Do we need to see that 10 times? Is it 20 times? Or is it, if there's a rumor once, people never touch the stock again? 3 times is good enough for me. That's all I have to say on this one. The stock is still very cheap at a $41 share price. Remember, this was a stock who was in the 120s back in the first half of 2024. It's still way down compared to the peak. It's an extremely volatile stock, SMCI. Active option chains. People liked to trade options on that one. The revenue is super high. I mean, if you look at that price to sell, look at the enterprise value over forward revenue, it's a 1. So yeah, LifeMD is a 1, GCT is under 1. HIMS is not, HIMS as cheap as I find HIMS. Look at that. It's a free X. This one's a 1. So again, trading pretty cheap. How much am I paying for that growth? EV over GP over RG is a 0.19, so we're under 0.2, so that's cheap. The rule of 40 is a 71. I mean, what's not to like? And no financial advice, of course, but yeah, what's not to like is the accounting stuff. But again, 3 times. They came out 3 times and said there would be no restatement. And especially what I care is the restatement in revenues. There was no restatement in revenues. So it's to me, I like the stock. I like the play. SuperMicro is all about liquid cooling. It's all about liquid cooling. They are the leader in liquid cooling for hyperscalers, for very large data centers. They are the leader. They've been working on this technology for, I think, something like 8 years. The CEO, if you look at the early marketing of CEO, it's all about green. It's all about saving the planet. He's been pushing liquid cooling for a very long time. That's his thing. And, they are very close to NVIDIA. In my first video of coverage of SuperMicro, I call them NVIDIA's friend. And they are NVIDIA's friend in my view. Anyways, we'll see how it goes. It's you could still have another short that comes out and says, "I don't believe the independent forensic accountant who said there was no fraud. I don't believe them. I know better than the independent forensic counsel. I know better, and this is what happened." And then we could go all over again. Remember, say a stock like DLO. I used to cover DLO. How many times has local DLO been attacked by a short seller? It's endless. So it's all about the perceptions sometimes. But the underlying stock I like, and I own SMCI. It's quite a small position for me, but I do own it. ELF. Let's talk about ELF. So ELF, I'm gonna say I own it, but it's literally a tracker position. So there's no, I don't have any economic attachment to this company. So yeah, I own its tracker position, but I really don't own it. It doesn't matter. It's less than 0.0001%. I just started adding it because I thought the play was good. And then the election happened, and of course, when that happened, the threats of tariffs on China came back at the forefront. And so if China has a 100% tariff, what do you think that's going to do to a company like ELF, which, unlike Oddity, ELF manufactures 80% of the makeup in China. ELF is a makeup company, by the way. They manufacture 80% of that makeup in China. Now, the stock went up after the election because the CEO came out and said, "Oh, well, that's going to be a second half of 2025 or a first half of 2026 issue." And of course, the market doesn't care about things that are 9 months from now. But I'm a long-term investor. I care about things that are 9 months from now. And so I think the tariffs could hurt health is what I think. So again, how many makeup plays do I want to have? I have Oddity. I think Oddity scores better on all of my metrics. I'm pretty happy with Oddity. I don't need more than one makeup play. But anyways, if you're interested in ELF, it scores really well. The revenue growth is 39% predicted over the next 12 months. The gross margin is 71%. The EBITDA margin is excellent at a 23, although note how close, it's that industry, right? Look at Oddity. Oddity, I get a 23% EBITDA margin, just like ELF. Gross margin, I get a 72% at Oddity, I get a 71% at ELF. And the forward growth is somewhat similar, 33% Oddity, 39% ELF. Now, ELF uses distributors, right? They sell at Target, they sell at, the Ulta, they sell at, I can't remember the name, but there's like this big German grocery store, German department store they sell at. They have distributors. And there are some issues with distributors that you don't necessarily have when you go direct to consumer. Oddity is direct to consumer only, which makes it impressive because the sales of ELF are just twice as big as the sales of Oddity. And Oddity is fully direct to consumer, fully online. ELF is a hybrid. They do a little bit of online, but they do a lot of their sales in stores, especially at Target. I was at Black Friday. I went to Target in Black Friday, and ELF had its Black Friday stuff at Target. So anyways, Rule of 40 is a 62. So that's very good and it's cheap. But I'm like I said, I'm holding off on this one, and I likely won't add. I will likely stay with Oddity. The last stock, a stock that I've been adding to recently, and it's Celsius Holdings. CELH is the name of the stock. Celsius Holdings. The forward revenue growth is 34%. Many people in the comment section, when I write 34%, they're going to tell me it's too high, and they're going to tell me I'm too optimistic, to which I tell you, you can recalculate and use a lower number if you want, but that is what I see by analysts. That is the number that I see. 34% future growth, the only reason why that's not going to show is because if you look deeply in the numbers, is because of the Pepsi distributor issues. Pepsi ordered too many cases, and now they have to unload the cases. But I think that if you remove the distributor from the story, and if you just look at the sell-through, in my view, the revenue growth is roughly that. It's roughly 30% a year revenue growth. I mean, it has taken the U.S. by storm for more than a year, maybe almost 2 years now, and it keeps taking over the U.S. by storm. There could be an energy drink trifecta in the future in the form of Red Bull, more on the decline in my view. Monster, kind of a stable market share, but not necessarily growing. And then Celsius, the new energy drink that is growing quite fast, and it is growing quite fast. And if you look at my coverage, I've covered it quite a bit. I call Celsius vitamins in a can, is how I call it. They have very interesting history. It was founded by co-founded by a billionaire in the vitamins industry, and they had some support from Li Ka-ching, believe it or not, like a major Chinese billionaire. Interesting play, interesting company. The founder of this company was actually pretty old. He passed away recently. So there's a long story in the making, and there's a long expertise in vitamins and nutrition behind Celsius anyways. How much am I paying for that growth? I'm paying a 0.24, which is right under my cutoff of the 0.25, and the rule of 40 is there at a 56. And if you look at the EBITDA margin, it's 22%, gross margin is 50. And if I'm going to invest in the food and beverage space, I much prefer the beverage space over the food space. So these are my super gems. These were it. Some I own, some I don't own. But what I want to point out is that you can see the average growth. If I were to average it out, what would I get in average growth? Like, would I get a 45% roughly, just looking at the number? 45, maybe 46% average growth, revenue growth on all of these. So going back full circle to the name of the channel, beat the denominator. The denominator, how many dollars are out there? The number of dollars out there, they're growing by 15%. There are 15% more dollars out there every year. These companies grow their revenue on average 3x, 3 times as fast. If they grow 45% the revenue and there's 15% money supply growth, you remove the 15% from the 45%, you still get a bunch of real growth. If any of these companies were only growing revenue at 15%, they would just be staying afloat. It would be the same as zero because I would remove the money supply expansion from that. The companies, just to stay afloat, they need to catch up with the money supply, and they need to catch their fair share of that new money supply, and they need to grow on top of that. And all of these companies do that, and that's why, you know, I guess I could say I identify as a growth snob. Like it's I want growth. I want to see this 30% growth. You know, there's a lot of good companies out there, but a lot of people cover. But the growth is 18%, 16%. I was seeing a report the other day about ASML. Yeah, ASML is a great company. It's also predicted to grow at 16%. So it's growing the same speed as money supply. That's not very appealing to me. But that's just my style. No investment advice, no financial advice. This was not financial advice, so just entertainment on this channel. Please like, please subscribe, follow me on X, follow me on Patreon. Thank you so much for watching. Thank you for the support. Welcome to all of the new viewers of the channel. I really appreciate your support of my work, and I hope you will like this video, even if you subscribed for MicroStrategy recently. I have a lot of new people who subscribe for MicroStrategy. I hope you'll like this video. Thanks for watching. Have a wonderful day.